First of all, on Air Force One, the president said that he's looking into treasuries right now. He said there could be a problem. You've been reading about that with treasuries, an interesting problem. It could be a lot of those things don't count. It's not really clear whether he's talking about our debt or payments that are processed through the Treasury Department right now. But heading into the Fed chairman's testimony on Capitol Hill, how likely is that to occupy top-of-mind concerns for investors?
Hi, good morning, Contessa. Thanks for having me. I think, in general, investors will remain concerned on the debt sustainability situation and the huge debt deficit situation in the U.S. So I guess, the term premium could still face upside pressure as a result. And generally, we believe that U.S. Treasury yields are likely to be trading in a range in the near term. Because I think investors, on one hand, it proves that in recent weeks, when the market sentiment weakened, actually investors go back to bonds. So there's a hedging purpose there for bonds. But at the same time, there's inflation risk and there's this debt concern risk that will push up the term premium. So I guess, it is very hard to say, but I presume we're going to be in a trading range for now. And if we hit about 5% again, that could put downside pressure on equities.
And we're seeing the hedging risk showing up in gold as well, hitting new highs. What about in Europe? Do you see that there's more opportunity for rate cuts in Europe than what might be factored in the United States?
Yeah, I think absolutely. Well, I'm sitting in the UK and we just got a rate cut last week. And I believe that UK data is likely to see further weakness. And, the bank would have to focus more on supporting growth versus worrying about inflation. I think, the base case is gradual rate cuts, about one cut per quarter. But there is certainly potential for, faster rate cut if the data gets worse. And I think for European Central Bank, the consensus is a couple more rate cuts, whereas our view is that the U.S., potentially could be 1 to 2 rate cuts by the end of the year, but entirely feasible. We don't see any rate cuts in the U.S. at all. So you get this, extending monetary policy divergence, which for us, we would favor, for example, UK gilts versus U.S. Treasuries.
And equities?
Well, equities, I think generally global equities should perform better than bonds. And in particular, we still prefer U.S. equities. I think the case for equities versus bonds is because general economic growth is still positive in the U.S., and I think that's very important. That implies corporate profits should continue to grind higher. U.S. equities, I think, in a trade war scenario, I think U.S. equities is still likely to perform better given it is more domestic focused, and also, the country that has a higher trade deficit is likely to lose less, relatively speaking. And I think U.S. equities are still likely to be regarded as defensive. So, proper profit outlook is still looking better in U.S. versus Europe and the other regions, for instance. So I would say we would still prefer U.S. equities. But again, given, the risk we have with trade and valuations and the sentiment at the moment, I think we are not going to get more bullish from here.